Typically, we recommend setting your revolving credit limit to your 1-year savings goal. That way, you can build up that balance over the year.
Wealth HQ, empowering you to take charge of your financial life.
Are you ready to learn how to structure your mortgage to pay it off up to 66% faster? In this video, we'll go over strategies to save you thousands in interest and help you reach financial freedom sooner by investing in more properties. Now stick around because I'll also review how to do a revolving credit facility that's going to work for you and why interest rate averaging might be the secret you've been missing. Here's the thing, if your mortgage isn't structured to fit your situation, you could be paying thousands more in interest and feel like you're not getting anywhere with it. But the right structure can help you pay your mortgage up to 66% faster, giving you flexibility for emergencies and even helping you invest in passive income sooner. When I first started in this industry, I thought there was just one best way to structure a mortgage. I assumed everyone needed a revolving credit account and interest rate averaging to save most interest. But I was dead wrong. The truth is, there are actually 3 critical factors you must consider for structuring any mortgages. First is flexibility, second, capability, and third, certainty. These are the keys to building a structure that actually works for you. Now let's start with the traditional 30-year loan. Here's a classic scenario. You have a $500,000 mortgage set over 30 years. The quickest way to pay it off, take every single spare dollar you have and put it towards your mortgage, increase your repayments as well. If you did this, most families could pay off a 30-year mortgage in about 10 years. But there's a catch. Every dollar that you have spare into your mortgage means you lose flexibility. You have no emergency fund, no holiday fund, no wiggle room, and that's where flexibility options like revolving credit facility comes in. Now, traditionally, you'd have a mortgage split into fixed amounts. For example, let's say $450,000 is on a fixed rate. You set aside $50,000 on a floating rate in a revolving credit facility. With a revolving credit, you pay a slightly higher interest rate on this portion. But here's the benefit. Every dollar you put in this account is counted against your principal. So if you have $10,000 sitting in your revolving credit, you'll only charge interest on the remaining $40,000 instead of the full $50,000 mortgage. That's every dollar working for you every single day. And when your income comes in monthly, even that extra dollar saves you interest. Plus, if there's an emergency, you can withdraw that fund without penalties. The extra 1% interest doesn't add up to much. Leaving $10,000 in your revolving credit only costs about $500 a year. But flexibility comes with responsibility. Revolving credit isn't right for everyone. If you're not disciplined with your spending, you could end up leaving this account empty and paying more in interest. So let me ask you, do you think you're disciplined enough to manage a revolving credit? Drop a comment below. Typically, we recommend setting your revolving credit limit to your 1-year savings goal. That way, you can build up that balance over the year. Then, when your fixed loan comes off term, you can use that saved amount to pay down a chunk of your mortgage, reset, and keep saving. Now, let's talk about certainty, because this is where interest rate averaging can make a big difference. Here's the reality. Predicting interest rate is hard. Remember when rates were around 5% and everyone thought they'd keep rising? Then they dropped down to 2.5 and then they went all the way up to 8%. And with inflation and other economic factors, rate increases are likely, but no one knows when. Interest rate averaging helps you take the guesswork out, and if you need predictable repayments, especially if you're running a business or have a big mortgage, consider splitting your mortgage into different rates. Part fixed short-term, part fixed long-term. But if your mortgage is relatively small compared to your income, say 3 to 4 times your household income, you might want to take a chance on a shorter term to save more upfront. It's all about balancing what works best for you. So let's recap. We've covered the 3 key factors in mortgage structuring. Flexibility with options like revolving credit to give you room for emergencies, capability to manage your funds effectively, and certainty with interest rate averaging for predictable payment. This is just an overview of mortgage structuring, and the best approach depends on your personal situation. That's why we always recommend talking to a mortgage advisor to see what's best for you.
Financial freedom. Financial freedom.
Wealth HQ, empowering you to take charge of your financial life.